Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service here on Seeking Alpha. And what I've done here, this is going to be the first in a series of articles where I'm going to be talking about answering some of the more important questions that investors have asked me over my almost 50 years in the industry. Questions like, when's the best time to buy or when's the best time to sell a stock? And I guess you would add to that, and how do you know? And all of that is rooted in the notion that it ultimately comes down to a business gets its value from the amount of cash flows. And you can measure that by earnings, by EBITDA, by cash flows, by free cash flows. The point is, it really comes down to simplistically stating a business that grows fast creates more value than a business that grows at a slower rate. And so even though I've covered this, and those of you who followed my work for a long time probably really understand this, and although most of this is kind of, common sense, I kind of know that it's true, and I certainly acknowledge that, but I also think that all of us should acknowledge the fact that these are these simple fundamentals, the basic blocking and tackling that goes along with investing often gets forgotten when we get into the mix of news, noise, happenings in the world, a hot market, a cold market, a bull market, a bear market. All those things tend to impact how we are thinking about investing. And the idea of having a sound fundamental basis for making your investment decisions means that you really are building a house of bricks rather than a house of straw. So I'm going to use two examples here of a very strong growing company, General Dynamics. It's a stock I've actually featured in several articles and videos that I've done recently. And I'm using it because it's a quintessential example of what I'm talking about. In the written portion, I talked about compounding. And I illustrated the difference between earning 10% over a long period of time versus earning a faster rate of or higher rate of return like 20%. So in this case, we're looking at General Dynamics, and I'm using it as my 10% example. And what I really want you to see here is this is a plotting of earnings per share going back to 2000, where the company earned $2 a share. The average growth, the average slope of this line, even though it has some different slopes in the middle, has been just under 10%, 9.9% per annum. And this is what I would call the foundational valuation of this business. This line is drawn to give us a valuation reference. In simple terms, I'm saying when the price is touching this line, the stock's trading at a sound valuation based on its earnings growth. In contrast, I'm going to show a company like Tractor Supply, and I've got no dividends here. I'm just looking at earnings right now. I want you to be aware of that, whose growth rate has been much faster, almost twice as fast, 19% growth, getting to the 20% growth I utilized in the written portion of this article. And here you see earnings go from 12 cents all the way up to $4 and expected to be $4.71. That's a significantly more dynamic increase in this income stream than we saw with General Dynamics. But if we look at that and we think about how that works and how that gives the value, if I put monthly closing prices on the graph, now I get a chance to understand and think about some very important aspects. Number one is, notice that the price in the long run does track earnings. In the short run, and in the short runs, I should say, plural, there will be times when price gets above fair value and there will be times when they get below fair value. And sometimes those disconnects can be very quick and very short-lived, like we saw back here in 2002. We saw overvaluation, quickly revert to the mean, turn into undervaluation, and then quickly revert back to the mean. And remember, this is a reference line. This would still be the stock trading at fair value. It was within a reasonable range of that, what I call earnings justified valuation. But here we see an extended period of undervaluation. Now that's a reality, and I talk about this in the article. When the market's undervaluing a stock, Ben Graham said in the short run, the market's a voting machine. Long run, it's a weighing machine. The market was clearly undervaluing this stock, but it did it for several years. It was undervaluing the stock here, but it only did it for a few months. And then once the market turned around and momentum came back into vogue on this stock, it actually overshoots like typically happens. And then we had this period of very high valuation, and then it moved back into fair value, which is about where it sits today. So when I look at performance, this 9% growth, and I'm only going to look here at the capital appreciation portion, turned into the 9.9% growth gave us 10% capital appreciation. That's almost identical to the company's growth rate. The only minor adjustments were slight differences in the valuation here. In the short run, all kinds of things happen. So when do you know when to buy and when do you know when to sell? When you can identify a company and you have a solid framework for identifying the intrinsic value of the company, you can know and trust that the company's undervalued when it's trading at these low PE ratios like we saw here. And when it gets overvalued, you can trust and understand that it's overvalued. Now, it's arguable that you could have made a rational decision to sell it here, to sell it here, to sell it here. All of those would have been smart decisions. Even selling it down here would have been a smart decision, because had you bought it here, even though the stock was slightly overvalued and held it to here, you would still make money. You'd make about 8.7% per year. In contrast, if you'd have bought it a few months earlier when the stock was fairly valued and held it just a few months longer, you'd have averaged 11% annualized. So valuation has an impact. And again, there is no perfect time to buy or sell. Any time here would have been a good buying point. Any time here would have been a good buying point. Really, any time here would have been a good buying point. So you can never know with precision. You can only know within a reasonable range of soundness whether or not a stock is a good buy or not. Now, if I go on and look at the faster growing example I've found here for you, Tractor Supply, where its growth has been almost 19%. Once again, you see the same scenario. You see overvaluation revert. It lasted a very short period of time here. Then you see this very extended period of time of high valuation. But eventually, even if you'd have bought it here and it still rallied, the price here would have been $67 in September of 2013. The stock, rallied all the way to $96 by May of 2016, but then it inevitably fell back to $55. So you could argue, not including dividends, which I've not included on this graph, you lost 2 or 3 years of value. And that's the point of knowing when to buy and when to sell, is that you are positioning yourself when you buy at value to participate in the growth of the business. When you overpay, you no longer are participating in the growth of the business. You're just participating in how the market is valuing the business. So you're not participating in intrinsic value. You're participating in what I call market value. Now, in order to summarize and kind of close this video, I want to just take a look at EBITDA here. EBITDA growth in millions of dollars for the faster growing Tractor Supply. You can see that EBITDA started out at around $34 million by the end of December 1998, and over the years it grew to over $879 million by the end of 2018. This revenue growth here, EBITDA growth if you will, is what gives the stock value. If I go back to General Dynamics and look at it real quickly, that grew half as fast, I still get conceptually a similar picture. I get strong EBITDA growth over years. It went from $668 million, though, to only $5.22 billion. So the point is, this massive increase in cash flows is what creates value. And that value is what's going to determine where you should be buying the stock if you want to get optimum results. You can overpay for a stock like General Dynamics or Tractor Supply as long as they keep growing and still make money. But you don't get the full measure of what the company is capable of offering you. So this is just this is going to be a building process as I go through this series, where I'm going to be interjecting more and more principles of valuation and how it works. But here's 2 good examples where you've got reasonable alignment of valuation in the beginning and reasonable alignment of valuation at the end. In the case of Tractor Supply, which grew earnings at just under 20% a year, 19% a year, when you look at its performance, you can see that it was very close to that. It was 25%, turning $10,000 into almost $1 million over this time frame, where in contrast, if you look at General Dynamics over roughly the same time frame, growing at about half the rate, it turned 10,000 into 69,000. That's not including dividends. Again, my point is, I'm really trying to focus here on the source of what gives a company value, and that value is the amount of cash flows it's capable of generating for its stakeholders. And clearly, a faster growing company generates more value for its stakeholders over time than a slower growing one. That's one of the principles of valuation, but that's future value. And I'm going to be also talking about present value relative to future value in subsequent components and installments of this series. This has been Chuck Carnevale saying thanks for watching. I appreciate it.